Good morning, everybody. Welcome to Windsor Brokers Live Daily Market Outlook for Monday, 28th of January 2013. The week starts with the extremely positive tone, continuation of the positive sentiment for the single currency and dollar-yen established last week as euro euphoria continues to focus the important 135 barrier as the pair reached levels close to this strong resistance zone. More scope is seen now for a break above these levels. The highlights of the recent trading, of the recent movements come as follows. As we said, strong risk appetite keeps the euro upside well supported and sees the potential for a test of strong 135 barrier, also breakpoint. We're going to elaborate more about this level as it's quite important. We have several strong points in the 135 area, and basically break above this level could be a trigger for some stronger gains towards initially 138. From the fundamental side, the euro bulls remain supported as the mounting signs of economic confidence and the stronger recovery of the Eurozone economy keep the investors back in play for further longs of euro against the dollar and against other major currencies. European banks, in surprisingly positive news, showed that they are repaying more than expected of the emergency loans given by European Central Bank during the debt crisis, and this is another supportive element as the ECB announced last Friday that 278 Eurozone banks would repay 137.2 billion euro borrowed in December 2011 under the 3-year long-term repo operation, well known as LTRO, and this is another supportive element for the single currency. Also, the data released from Germany last Friday showing that business morale hits highest in more than 6 months. That keeps the single currency afloat. Last Friday's weekly close above 134.00 from the technical point of view remains supportive for a fresh attack higher, though the single currency against dollar is currently in the slight corrective mode. Profit taking ahead of, I would say, hesitation ahead of strong 135 barrier is something expected, and as long as we stay above initial and strong support at 134, immediate scope remains for attack at significant 135 area. A brief look at the other currencies. Sterling remains under heavy pressure as the early European trading pushed the pair significantly lower as the week started with gap lower opening and the 157.14 seen so far. Our next target and at 157.00 comes under increased pressure. Dollar yen remains one of the top performers as last Friday's extension and cracking the 91 psychological barrier reached 91.24. Currently the pair is in the corrective mode, and initially you see the good support at 90.23. This is initial support, previous highs, and it's also reinforced by 20 days exponential moving average. And finally, dollar Swiss bounced off last Friday's fresh low at 92.20 with recovery showing good signals, at least on the hourly chart, where the studies turned positive, but descending 55 days hourly moving average so far limited the action ahead of psychological 93 level and 93.23 previous high. Basically, if we see the break above these levels, then we can be talking about a stronger correction. Otherwise, the downside remains in focus as a part of the larger reversal from the recent peak at 93.87 that so far retraced approximately 50% of the initial 91.09 to 93.87 rally. And a brief look at the commodities. Crude oil remains still supported. Basically the price entered the range trading between 95.50 and the 96.60 zone with the current neutral tone seen on the hourly chart while the larger picture is still holding positive elements as long as we are holding above 95 support, while gold shows increased signals of weakness as last Friday's dip to fresh low at 1655 approximately keeps the risk at the downside, and our next target and strong support lies at 1650. From the other important news and comments after ending the Davos Economic Forum, the highlights are as follows. Bankers and the policy makers say that the European crisis is not over, and though the euro currency is now stabilized, it will take years to overcome economic crisis and mass unemployment in Europe. After a private meeting of leading commercial bankers, government officials, central bankers and trade union officials, this was the final comment. Some comments of the officials saying that this is a clear divide between the financial markets, who think a lot of this is fixed, and the people in the real economy, and particularly from our side, as the government's unemployment in Europe would only fall from 11.8 to 11.7% this year, and growth was stagnant. Real wages were not rising in most countries, and it would take countries such as Sweden and France years to reform their labor market. Also from Davos, comments from the top officials saying that world's business and the political elite looks for a greater American engagement to tackle the world security challenges, as there are a number of conflicts worldwide, and even American top officials were not present in Davos in the forum. There were some lower ranked, let's say, the representatives, but obviously it was obvious that the top American officials, including the President Barack Obama, who is now in the inaugural week, were not present at the Davos Economic Forum. And the Fed is approaching its 2 days meeting that starts on Wednesday, and the expectations are that the Federal Reserves would likely stay hold basically unchanged into 2014, as the jobless rate still high, and the expectations to fall to 6.5% are required to act and start raising the interest rates. Until then, most likely, these were the comments from previous meetings also, that they estimated that in 2014 we can expect some changes in the policy, as the current situation does not allow the Federal Reserves to act more significantly and change its ultra-loose monetary policy. And a brief look at today's calendar before we move to the technicals. Not many releases seen today, as it's Monday, beginning of the week. I would say the important things come from America. We have the durable goods orders due at 13:30. Forecast is 1.8% for monthly December release compared to 0.7% of November's release, while core orders are forecasted at 0.8% in December versus 1.6% in month of November, and pending home sales in December are expected, according to the forecast, to dip to 0.8% compared to 1.7% seen in November. And basically these are the top releases for today from the world markets. We are going to move now to the technicals and see the latest movements following the start of the week and the results of recent rallies of single currency. That is our first instrument to be seen. We are in the corrective mode as shown on the hourly chart of recent peak posted last Friday at 134.54, with the weekly close seen at 134.60 approximately, keeping the we set in our analysis last Friday that any close above 134 would be well supportive for the single currency. Basically now we are in the corrective pullback due to the overbought hourly conditions, as show the RSI is already emerging out of the overbought territory, and all other indicators are descending. Basically, we have 134 zone as initial support. That is approximately 38.2% retracement of the initial rally from 132.64 to 134.77 as the price approached significant 134.85, 90, 135.00 resistance. We're going to take a look on this later on. At this point, ideal point, reversal point is seen as at 134.00. This also marks the previous resistance, previous highs, and the support is reinforced by ascending 20 days exponential moving average on the 4-hour chart, along with the Fibonacci 38.2 level, seen as the ideal point. Now, the other thing from the weekly chart, we can see that the pair is approaching very significant and strong resistance at 135 zone. What we have here, we have the 134.85. This is 2012 high posted in February 2012. Longer term descent of 149.38. This was the upside rejection in 2011 on approach to 150 from 149.38 down to 120.42. 50% retracement of that down leg. Also, the weekly inversed head and shoulders chart, the head and shoulders pattern neckline that again falls at this zone. And finally, weekly 200 days moving average slightly above at 135 at 25, making the 135 barrier as key point and break point for some stronger rally, for stronger recovery of the previously mentioned 149.38 to 120.42 descent. Positive tone exists and is seen supportive so far in the number of studies, with the daily and weekly being well supportive, as well as 4-hour indicators that are now pointing lower due to the pullback. But overall, positive tone sees room for a possible fresh attack and break above 135.00. Of course, we have to consider that a stronger hesitation ahead of this strong barrier cannot be ruled out at this point. As we can see, the 4-hour indicators, 4-hour RSI is now coming out of the overbought territory, signaling that we might see even deeper reversal below 134.00, where we have another good support at 133.60 zone. These are the one of the previous range, previous highs, and the consolidative range top, along with 23.6% retracement, and 133.40, which is dynamic support, 55 days exponential moving average. Any dip towards this zone will still keep immediate bulls unharmed. I would say the risk will be seen on a break below 133. That also marks near 38.2% retracement of the larger upleg from 129.96 to 134.77, and finally the previous range floor at 132.50. Only break here would be more significant for the euro, as this would sideline immediate bulls and keep bears in favor for some stronger corrective action. As long as we are holding above these levels, the pullback would be seen as corrective action and preceding a fresh attack at 135.00. That is basically our upside target and the key and strong barrier. Break of this level, again, we can see the next targets at 138 zone. That marks 61.8% retracement of the larger 149.38 to 120.42 descent, and basically there is no significant levels until there, where this stands at 138.32 approximately, and seen as the next on a clear break above 135.00. In the short term, this will be the next upside target. From the other side, sterling remains under heavy pressure as bears now are taking control, as we can see on the hourly ADX chart, as well as 4-hour chart that shows the bears are fully in control. Brief support was found last Friday at 157.50. That was our initial target, but recovery attempts failed at 158.25, basically failed to sustain gains above important 158 barrier, and subsequent weakness accelerated on the weekly gap lower opening, with a fresh slide came at the beginning of the European session, dipping so far to 157.14. That keeps immediate focus at our next target, 157.00 psychological support. Some corrective action and hesitation might be seen on approach to 157 as oversold hourly conditions, and the negative 4-hour chart indicators see more potential towards the downside and the possible attack at 157, close to which is also the 61.8% retracement of the larger rally from 152.67 2012 low to 163.80 2012 high, marking the 157 area as a strong support, but this is our initial downside target. On the upside, any correction higher requires break above, requires first regain of initial 157.50 resistance, then this high at 157.84, filling the gap and break above 158 may provide a temporary relief, but as long as we are holding below 158.25 last Friday's high, and not much to be expected, as a likely scenario would be lower top and the fresh extension lower, only break above 158.25, sustain break higher and probably daily close above this level would be a signal of near-term basing attempt and would allow for some stronger corrective action. Until then, more focus is still seen towards the downside, and the possible breach of 157.00 is to open 156.34 and then 156.00 seen as the next targets. As we can see, the daily high, overnight high at 157.83 is also reinforced by a 61.8% retracement of the down move from 158.25 to 157.14, also descending 20 days exponential moving average, marking this level as a quite a strong barrier, and only filling gap and the lift above 158 would signal some improvement in the currently negative outlook for the cable. Dollar yen hit, as we said at the beginning, a fresh high at 91.24 at the beginning of the Asian session, and currently is in the corrective mode. Strong bulls seen on the all time frames, signaling that the rally is not over yet, and the most likely extension towards 92 could be a likely scenario. Overbought conditions on the 1-hour chart are seen as a trigger for a current pullback that so far dipped at 90.57, seen as a minor corrective action, just ahead of 23.6% retracement of 88.05 to 91.24 rally, and ahead of this we have 90.41 day hourly 55 days exponential moving average, while on the 4-hour chart overextended again conditions do not rule out some stronger corrective action. Good support lies at 90 zone, that is previous 90.23, along with the 20 days 4-hour 20 days exponential moving average, and then 90.00 is 38.2% Fibonacci retracement. Ideally, any stronger dips should be contained at or above 90.00 in order to keep immediate bulls in play for a fresh extension towards our next upside target at 92.00. However, any stronger reversal would still keep the bulls unharmed, I would say, until 89.64, that is 50%, and 89.47 approximately dips into 89.50 zone, not breaking this level, would still keep immediate bulls unharmed and keep the focus at the upside. Break below 89.50 would delay and signal some stronger corrective action. And from the currencies, dollar Swiss is our last instrument. Near-term bulls, as shown on the hourly ADX, are in play now as the pair stretched to 92.87. That marks approximately 61.8% retracement of the latest down leg from 93.23 last Thursday's high down to 92.20, which is the low of last Friday. Approaching this level sees potential for a possible extension higher, as hourly studies remain supportive for now, though the stochastic is already reversing lower and RSI starting to pointing lower as a part of the larger down move from 93.87 peak of 18th of January. That so far retraced approximately 61.8% of the rally from 91.09 to 93.87, with the recovery attempts being so far contained and capped basically by 20 and 55 days exponential moving averages on the 4-hour chart, seeing as a good barrier for now, and seeing capping ahead of fresh extension lower, as 4-hour indicators are still rather negative and still see more room towards the downside. Any rejection under 93.00 would risk a lower top and a fresh push lower, with the break below 92.50, I would say, required to confirm that 92.20 low is coming in play ahead of 92.00 as our next downside target. To avert immediate downside risk, we need to see the clear break above first psychological 93.00 and then the high of last Thursday at 93.23. That would allow for some stronger corrective action and stronger reversal and prevent further slide down towards through 92.00 towards 91.00, 90.80 strong support and the near-term base. 93.23 also marks a 61.8% retracement of the downleg from 93.87 to 92.20, and the break here is seen as a break point that will shift again focus towards the upper levels at 93.87 and then 94.00. And from commodities, crude oil entered the range, trading at this point. There we have no trend as shown on the hourly ADX as well as 4-hour. The trend is seen defined on the upside. Basically, there was a failure to clear last Friday's rally, was capped by the triangle resistance approximately at 96.50, and the price then broke below the triangle support. That was approximately initially at 96.00, with the further extension lower now seen more likely as 4-hour indicators are now breaking below the midlines, while the hourlies are still in the neutral mode, as the price is entrenched between 95.40 and approximately 96.50 range. Break of either side is to define the near-term direction according to the hourly chart, but on the 4-hour the tone is still aligned towards the downside, as the pair is unable, the price is unable to break the descending trend line of 96.90, 23rd of January high. That sees still more risk towards the downside. Support and range floor at 95.45 is reinforced by 55 days exponential moving average, along with the 95.00 recent low and the strong support, and the break below these two levels is to further soften the tone and open way for further retracement of the stronger rally. However, larger picture is still keeping the upside in focus, despite the quite extended conditions shown on the daily chart, with the $100 per barrel still seen as a short-term target for the crude oil price, as it is in the strong rally from 84.05 low of 7th of November and 85.20 higher low of 11th of December 2012, breaking some important levels, with the current gains being so far limited at 76.4% Fibonacci retracement of the larger 172 to 84.05 descent. Basically, the current movements are seen as consolidation. As long as we are holding above 95.00, scope is seen for a break above 96.79, 97, 96.90 to open way towards, basically there will be open way towards 100, as there is no significant barriers except 98.30 previous highs towards $100 per barrel, strong resistance and psychological barrier. And finally, gold, due to the increased risk appetite, most of investors are now jumping into riskier assets and coming out of the safe haven instruments. That shows the current price action of the yellow metal, as it was unable to clear 1700 as psychological and strong barrier. Several attempts were seen here ahead of a fresh slide that so far retraced nearly 61.8% of the recovery rally from 1625 low of 4th of January to 1697 peak of 17th of January, with more scope seen towards the downside and possible test of a strong support zone at 1650. We have 1653, which is the 61.8% retracement, and the low of 9th of January at 1651. And basically the confirmation. Also we have the broken bear trend line of 1752 that now acts as support, and a break below this line as that acts also as a support zone approximately at 1650, reinforcing the 1650 support would signal further weakness and possible return down towards 1625, with interim support seen at 1642, which is low of 7th of January 2013. Recovery attempts as shown on the hourly chart are still quite brief, and they, I would say, rather seen as consolidation than correction, as the gains were so far limited at 1662, far from the next resistance, previous support at 1684, with the price hovering around the 20 days exponential moving average that is currently standing at approximately 1660, with the near-term down move being maintained by descending 55 days exponential moving average that offers initial barrier at 1667 and static resistance at 1672. At this point, break above 1672, that is just above 38.2% retracement, would be a signal for some stronger recovery. As long as we are holding below this level, more risk is seen towards the downside, and the asset initial targets are at 1653, 51, 50. So 1650 zone seen as the next downside target, break of which to allow for further weakness set towards 1642. That marks also 76.4% Fibonacci retracement of the rally from 1625 to 1697. And this will conclude today's presentation from my side. Please, if you have any questions or suggestions, you can type, submit them in written, and I will answer to you immediately. Or you have any request for any other instrument, I'm ready to assist. As said, if you have any questions, you can raise them now. I noticed that some attendees connected later. If you are not aware, if you miss any part of the session, you can always find the recorded version in the YouTube on our page called the Windsor Brokers Forex, where you will find the whole session recorded. And it seems that we have no questions for today's session. In that case, I would like to thank you all for attending our live session. Also to say welcome to some new names that I see first time today, and I hope you will stay with us. Expect to see you again tomorrow morning at the same time at 8 o'clock GMT, 10 o'clock local Cyprus time. Until then, I wish you a nice beginning of the week, nice Monday, and of course very profitable and successful trading. Good luck.